Hello, this is Josh Robb from Hixon Zuercher Capital Management, bringing you the September 2015 Economic Update. With me today is Tony Hixon, co-founder and wealth manager here at Hixon Zuercher Capital Management. Today we're going to talk about how the last month has affected investors and what that means for an investor like you. Tony, last month there was a lot going on. There was the federal rate hike, thoughts about when that'll happen, if it will happen, the Greece debt crisis, and then the China economy slowdown. Give me some thoughts on that, please.
Sure. Well, you're right. It was a rough month in August for financial markets, and a couple of things that you had mentioned. Number one, the Greek debt crisis. Well, for the most part, that pretty well got resolved. At the 11th hour, the European Union came to an agreement where they were going to bail out the Greek economy. And in so doing, it kind of calmed markets toward the beginning of the month. We're not going to say that it's over, though. Last month in our video update, we talked about contagion. There are other countries within the European Union that are also over-indebted, just like the Greece economy was. So we'll keep an eye out across the pond in the European economy to find out if there are other countries that might struggle with the same issues that Greece has. The other thing that you had mentioned too was the Chinese slowdown. The economy of China started to experience some signs of potentially going into a recession. And whenever you hear the word recession, that automatically drives stock market volatility. The Chinese stock market, the Chinese economy, is the second largest economy in the world. So we are certainly concerned about what might happen if the Chinese economy would start to slow down. Over the past few years, the stock market has been in a raging bull market, rising over 150% in a short amount of time. But within the past couple months, the stock market has entered a bear market, down over 30% from its highs. And so here in the U.S., we're watching that with a lot of interest to find out if that economy does sink into a recession, how that'll affect our country and our economy. That drove a lot of volatility throughout the month. And then the third thing you mentioned was the Federal Reserve's impending rate hike. Potentially, in a couple weeks from today, the Federal Reserve will meet for a 2-day meeting, and they will decide whether or not to implement the first rate hike in over 9 years. So it's a big deal for the economy in that interest rates do affect a lot of areas of the economy. We talked in other video updates how a rise in rates, a rise in federal funds rate will eventually trickle down to a rise in interest rates in automobile loans, student loans, credit cards, mortgages. So that decision does impact our economy, but we'll talk a little bit later about how we think that will actually impact the U.S. stock market.
Real quick, you mentioned Chinese economy was the second largest. How does that affect our economy or our GDP? Are we really reliant on China?
It's a good question. Actually, we did a little research and we found that only 0.7% is exported to the Chinese economy from our country. So we are not heavily reliant on how the Chinese stock market does or how the Chinese economy does. 0.7% of our GDP is exported to China.
Okay. So with all those negatives going on in August, it was a very rough month in the news. Something was happening every week, it seemed like. Is that indication that we should just go to cash, be running for the hills? What does that mean for our economy? Is there anything positive you're seeing?
It's a good question, Josh, and we actually get that question quite a bit from clients. And I guess our research is showing that there's really no serious fundamental problems right now. A couple of examples of how robust we think our economy is. Number one, private sector jobs. They've increased for the past 65 consecutive months. This shows real strength in our economy. There's improvement in housing and construction. Automobile sales are continuing to grow and reach record highs. And corporate profits are continuing to reach record highs as well. All of these things tend to bode well for the U.S. economy. Next, I would talk a little bit about quantitative easing. That buzzword we've been using for the past few years when talking about the 2008 financial crisis. And everyone thought a year ago, when the Fed put a stop to quantitative easing, they thought that the world would go into an abyss. Well, it's been about a year, and that hasn't happened. We've actually increased our economic growth quite handsomely. In fact, last quarter our GDP was clocked in at 3.7%. So now that the Fed has removed the sugar bowl, the market and the economy has continued to do well. Now the issue is, will rate hikes affect our economy? Well, again, we would say that our economy is doing well enough to support a small rate hike. Next, talk about China is slowing. Well, as we stated before, it's just a very small portion of our overall GDP that is being exported to China. It doesn't seem like a slowdown in that country will affect our economy very much. We talk about the Chinese yuan and how they've increased its value or decreased its value, and you'll hear on the news media reports that the Chinese yuan will be the reserve currency. Just 3 months ago we heard that instead of the US dollar it would be the Chinese yuan that would be the reserve currency. Well, now that they've devalued it, now we're concerned about that. It's hard to believe, hard to know what side of the fence to be on and how many things there are to worry about. We'd say that it's a non-issue. Corrections are a part of a free market economy. There will be pullbacks. There will be times that the stock market doesn't go infinitely in the upward direction. These are times when we take money, when we move capital from weak hands to strong hands. And those who have the strong hands have the stomach to withstand some of these pullbacks and corrections, knowing full well that we live in a great economy. The U.S. is doing very well, and that this is a chance to buy stocks on sale and to put cash to work during this time.
Okay, so looking back, we did see a lot of those scary headlines, but like you said, it's not all negative. There's some good stuff. What do you see then moving forward? What are some of the things that you want to highlight that in the next couple of weeks to keep an eye out for?
Well, certainly, Josh, in September 16th and 17th, that Federal Reserve meeting, a 2-day meeting where they'll decide whether or not to increase rates. That's something that we've got our eye on, and the markets have their eye on as well. So I guess the word that a lot of us are getting tired of hearing, but it describes what we need to keep our eye on, would be volatility. Just this past week, the market was down 460 points one day, and the next day it came up 300. So there's going to be a lot more of that, we think, in the days and weeks ahead. But pushing beyond that, typically the fourth quarter of a year does really well as the economy starts to settle down from families getting back from summer vacations, going back to school. Christmas is coming. A consumer-driven economy is supported well by the Christmas season. So a lot of companies will be reporting really strong results from, we believe, a good Christmas season coming up this year. So that's what we see in the days and weeks ahead.
Thank you, Tony. This is Josh Robb and Tony Hixon from Hixon Zuercher Capital Management giving you the September 2015 economic update. Once again, everything here is not an investment advice, so if you do have any questions or concerns, please contact your advisor. If you would like a second opinion from us on your investments, please call 419-425-2400. Once again, this is Josh Robb and Tony Hixon from Hixon Zuercher Capital Management. Thank you very much.